Palantir reports Monday after the close. The business is growing at an extraordinary pace, but the stock trades near $123 and roughly 138 times trailing earnings. The question is not whether Palantir is impressive. It is whether Monday's numbers can justify a valuation already pricing in years of near-perfect execution. Palantir sells software platforms that help governments and companies combine data, run workflows, and deploy artificial intelligence applications. In the first quarter, revenue reached $1.63 billion, up 85% year-over-year. U.S. government revenue grew 84%. Management's commercial ambition is even larger, more than $224 billion of U.S. commercial revenue for 2026, at least 120% growth. For the quarter arriving Monday, management guided to revenue between $797 and $801 billion and adjusted operating income between $063 and $067 billion. For the full year, it raised revenue guidance to $650 to $662 billion and adjusted free cash flow to $4 billion. Those are not vague AI promises. They are explicit targets. The problem is price. At $123.06, Palantir's trailing price-to-earnings ratio is about 138. Analysts' average 12-month target is 182.20, but their range runs from 70 to 255. That spread matters. A high target can coexist with a high risk of disappointment, because even a strong quarter may be treated as insufficient if growth merely meets expectations. Palantir's last quarter showed why the debate is so intense. Revenue and adjusted earnings were strong, yet the stock fell about 6.9% after the report. Investors focused on whether commercial growth was accelerating fast enough. This Monday, watch total revenue, U.S. commercial growth, customer additions, and whether management raises guidance again. The bull case is clear: 85% reported growth, a 71% full-year revenue outlook, expanding government demand, and a software model with very high margins. The bear case is just as clear: a 138 times multiple, huge expectations, stock-based compensation, and an earnings reaction that can punish even a beat. This is a great business, but not an obvious bargain. My verdict: Palantir belongs on the buy list, not in the chase list. I would avoid making a full-size purchase before the print. If revenue lands near the $1.8 billion guide and management raises the outlook, a staged position after the reaction makes sense. If growth or guidance slips, the valuation demands patience. Monday's release is the test.